All right, good morning, guys. And I want to welcome you to lecture 5 of our FR paper 2.1 ICAG. We want to look at some other standards, including agriculture. We will later go on to talk about inventory, IAS 8, IAS 10, IAS 12. All right, now we want to look at agriculture. And this IAS standard is usually untaught because hardly has they been examined, but you never know. So we want to go through and talk about IAS 41. Now, the IAS 41 relates to what we call the biological assets. And the combined grants in there, because these are the sectors where usually you get grants. Okay, you get grants, and what we are going to go through and also look at are the agricultural products. The agricultural products. And for the agricultural product, you are going to look at it at the point of harvest. At the point of harvest, all right. So you realize that products that come as a result of processing your harvest will now be dealt with under IAS 2 because it becomes an inventory or maybe any other applicable standard. Right. So we want to go ahead and try to talk about what we are supposed to go through and learn under the IAS 41. As usual, like I said, I will start with definition. So let me put in definition here. Okay, then done with definition, I'll go on and talk about recognition here. And I will talk about measurement. Okay, but before I do all these things, let me just categorize my board and split these things as I have described in here for you. So we have biological assets. All right, and that is what we are going to go through and talk about here. Now, we say that IAS 41 is about agriculture, and what we are actually looking at in here is the biological asset. All right. So, what is the definition? We are talking about biological assets. Recognition, we are talking about biological assets. Measurement, we are still talking about biological assets. So that is what we are going to go through and look at. Okay, grant has been dealt with, and when we are through this one, then we will now come to the agricultural produce. All right. So what is a biological asset? What you are supposed to know is that a biological asset is a living animal or plant. A living animal or plant. These are what actually embodies agriculture. All right. So anything that is living is a living animal, or a plant is a biological asset. All right. That is very, very important. That is very important. We now need to go through and talk about some examples of biological assets. So IAS 41 continues to tell us that all these things are biological assets, as you said here, unless it's a bearer plant. We will come back and talk about what a bearer plant is, unless it's a bearer plant. All right. Okay. Now we all know that some plants are actually there to be used for reproduction. So in terms of it, those bearer assets becomes a PPE staff. Now, when we say a bearer asset here or a bearer plant here, what we are trying to talk about is that that particular plant plant is used to produce or supply agricultural produce. Okay. So one is used in the production or supply of agricultural produce. Of agriculture. So you realize that there are some plants that are there. They themselves are not the product, but they themselves exist so that we'll be getting some product out of them. All right. And number two, the thing is that it is expected to bear fruit for more than one period. Okay, so they produce and their production of fruits, the asset is expected to bear fruit for more than one period, just like a PPE. All right, one period. And so we say that the bearer plant is a PPE. So number one, that tree itself or the plant itself is used in the production and the supply of agricultural produce, and it's expected to bear fruit for more than one period. The last thing that gives it recognition is that it has, we say, a remote likelihood, all right, or there is no likelihood. There is no likelihood of it being sold, as a produce, as an agri produce, except for incidental sale. All right, except for incidental scrap sale. All right, you have no intention of selling it, but maybe because it is hedging towards its dead and you are now selling it off. So when you see these things happening to a particular plant, then it means that that plant is a bearer plant, and that one will be considered under PPE IAS 16. This is a twist that has come into the standard. It did not used to be like that, but a review of the standard has brought this to play. So what you are supposed to know that is that any biological asset, that is any living animal or plant, unless that plant is a bearer plant. Okay, and when we say a bearer plant, we are talking about a plant that is used in the production or the supply of other agricultural produce. All right. And number two, is expected to bear fruit for more than one period. Another thing you are supposed to know is that management has no intention of actually selling that biological unless they are just selling it. Okay. All right. What we are now supposed to go through is to go ahead and talk about the recognition criteria of biology. Okay. Now, what are the recognition criteria of a biological asset? It is an asset, and therefore we say um, probable economic benefit. Probable economic benefit will flow to the entity. To the entity. All right. What we are supposed to add is that the cost, and in this case, the fair value uh, can be measured reliably. And the last thing we need to introduce is that it is an asset, and therefore the entity controls the asset. All right. The entity controls the asset. In this case, the biological asset. All right. So that is what we need to go through. When it comes to this agriculture biological asset, if we are talking about the measurement criteria, we have initial measurements, and subsequent measurement. What we are supposed to go through and understand is that for the initial measurement, we have two. We have the measurement at fair value less cost to sell. All right, fair value less cost to sell. So that is the priority, the default one. So we have fair value less cost to sell. Now, if there is no fair value available, then it means that we need to go through and apply the cost model. But the cost model is applied only when the fair value is not available. All right, only when there is no fair value. Now, what we are going to understand is that when it comes to the subsequent measurement, all revaluation is done to fair value. All right, every year we are supposed to revalue to the fair value at the point of the end of the year, okay, or at the point of sale. All right, so that is what you are going to do. So you revalue at fair value. All right, less cost to sell. All right, less cost to sell at year end. And any revaluation surplus or any gain that comes in it. All right, any revaluation surplus will go where? Will go to the P&L. All right, so that is it. That is it. Okay. So what are some of the examples of the biological assets that we are talking about? We are talking about um, biological assets. What can we come up with? What can we come up with? If you can know the bearer plants, then it means that all the other ones that we know, living animal and plants, will now be our uh, biological assets. Okay, that is it. As for the bearer plants, we have the vines, the tea bushes, and other trees that may be classified as PP under bearer. But so we have, so you could see that there are so many assets that could be for here. It's about the intention, all right? It's about the intention. Okay, so take note. Examples of these are sheep, all right? So at a point, even some of the plants may stand as a bearer asset, especially plants, all right? So hardly do you sell plants. But as for the animals, very likely you can sell them. Okay, very likely. So they even sell them on a yearly basis for Christmas and Eid al-Fitr or Eid al-Adha. Yeah. Okay, so that is that. So we have sheep, we have the cattle, we have the pigs, all right, the animals. You can go on and mention them. Okay, we have the fruit trees, the grape trees. So what you are supposed to understand is that even if these trees, whatever we are talking about, has these three recognition criteria stated in the question, then you need to go ahead and treat them as a bearer of plants. All right. So be careful, and be able to distinguish between the two. All right. So you can get more examples that you want. All right. So these are what concerns the biological assets. These are what concerns the biological assets. Now, what we are supposed to go through and know is probably take a question and see how these ones look like. I have a question here I need us to go through. All right, so there's a question here we need to go through. All right, it said a herd of 5-year-old pigs was held on January 1, 2013. On July 2013, a 4.5-year-old pig was purchased at this price. All right. Now, the fair value less estimated point of sale cost as figured here for us. So a 4-year pig sells like this in the market. A 4.5-year pig sells like this in the market. I think that's what we have here. And a 5-year-old pig as of December also sells at 230. That is what we have here. Okay. Now, the question says we should calculate the amount that should be taken to the SOFP, statement of profit and loss. All right. Now, what are we going to do? What we are going to do here is to go ahead and value our agricultural products here in our biological assets and see if there is any amount we will put to the profit or loss statement. So remember, it is done at fair value less cost to sell. So we are going to go through. So we have a head 4-year-old. So we have this at January. On July, 4.5-year-old. So it means that as at this time, the thing is 4-year-old. When we now move into July, it is 4.5-year-old, all right? And that is what is going to happen, all right? So you check the number of, you said that the number of pigs or the animals that we have ahead of this one looks like a group, all right, of 5-year-old pigs. So we have 4. So if you are now valuing our 4 pigs, our 5 pigs that are 4-year-old, we now need to come to the market and see the market value, all right, the fair value here. So we are having, as at January 1, we have 5 pigs, all right, and the fair value in the market for a 4-year pig is 200. So when we multiply, we are now going to go through and get 1,000 cedis for it. You could see that on July 1, a 4-year pig now is purchased as 212, and that is the fair value in the market. So we cannot be going on to be carrying just the fair value in those days again. Now, if they purchased one, all right, it means that on July 1, you remember opening stock at purchases, all right? So this one is our purchases. We bought one, a 4.5, and a 4.5-year-old is sold at 12. Yeah, so we are going to get our 12. Now, remember at this point, we have this amount to consider. Remember that we are supposed to go through and at subsequent measurement, measure the entire animals again at fair value, less cost to sell. It is something we have to do, whether the question tells us or not. That is what we are supposed to do under the measurement at fair value. So it means that what is going to happen is that if we bought this animal on this date and they were 4-year-old, it means that at the time we get to the end of the year, say 31st December, they are 1-year-old in addition. So it's going to be a 5-year-old animal. All right. This one we bought for 4.5. We'll also spend 6 months in the camp. All right. And it is also going to be 5-year-old. Those are the tricks that you need to do. So you will see that the 1 year, 4.5-year-old that we bought in the middle of the year is also a 0.5-year-old in addition, making it to also be 5 years. All right. We now need to go through and check the fair value of a 5-year-old animal in the market. So when you come here, you see a 5-year-old animal in the market. At this point, how many animals are we having? We are having 6 animals. All right, 6 animals. And that should be our carrying amount or our fair value now on the 31st December 2013. So we are going to go through now and multiply our 6 animals here by the fair value that is existing, less cost to sell. We have 230. We have 230. All right, because they are all now 5-year-old, and that is the fair value there. If you are going to go through and multiply this, we should end up with 1,380. All right. Now, what is going to happen here is that this being our carrying amount to the SOFP, we now see a difference here, which is a gain. All right. And that gain is how much? In 168, which will go here to our P&L. All right. So that is what you are supposed to take note of. Because of the years, you are supposed to be very, very careful. Supposed to be very, very careful. All right. So what we are supposed to go through and learn under the other side of this standard IAS 41 is to go through and understand what we mean by our agricultural produce. Agricultural produce. All right. These are the harvested products, okay, of a bearer or uh, uh, a biological asset. All right. Now, what we are supposed to go through is that how do we measure these? We are going to go through and measure them at fair value, less cost to sell. Okay. All right. Which is very, very, very important. All right. Now, if there is no fair value in this initial measurement, if there is no fair value determination in the market, then we need to go through and deal with the cost model. Yeah. In terms of subsequent measurements, we are supposed to go through and look at the revaluation. All right, revaluation. If there is any revaluation at the end of the year, we are doing it at fair value less cost to sell. All right, with any gain or loss uh, posted to the P&L. Now, what we are supposed to understand here is that it's a key note that we are supposed to know that after the produce has been harvested, all right, after this, what we are talking about, all right, this produce, so when it is an agricultural produce, um, after it has been harvested, so all these things we are discussing, all right, before harvest. Okay, so let me clarify here. We are saying that the produce of an agriculture. So let me clarify here by taking this harvest off because it can make it ambiguous. So we are talking about the produce of biological assets. All right, the produce, its potential. Okay. So after this produce has now been harvested, but whatever it is still a harvested product of an agriculture uh, asset. Okay, so that is it. Okay, so the key thing is that after all of them has been harvested, you realize that IAS 41 ceases to apply. All right, ceases to apply. Okay, so you're not going to go through and apply these things once they've been harvested. Okay, so what you are going to go through and do here is to now apply IS 2, which is inventory. Okay, all right, so that is that. That is what you are supposed to know. All right, what we are talking about here is at the date of harvest. So let me say the produce of biological assets at the date of harvest. All right, that is what I'm talking about here. So taking off this harvested to, clear the ambiguity. All right, so we say that the produce of biological asset at the date of harvest, the key bit is here, this one. Or the harvested produce of a biological asset at the date of harvest. All right, so that is that. And after the date of harvest, so after the date of harvest, the date of harvest, as we see here, IAS 41 ceases to apply. It's now become IAS 2. All right, so that is that. Now we are going to conclude this class by taking some examples of agricultural produce. We have the wool. All right, we have the milk. We have picked fruits, the ones that we pick. Then we have plenty like harvested cane. When was the last time you took sugar cane? The carcasses. All right, then the leaves, the picked fruits and the picked leaves. All right, all these things are agriculture produce. All right, so what we are going to go through is to treat it when it becomes what we call an inventory. So we are now going to go through and look at inventory. All right. But before then, let's see if we can take another question to deal with. Okay, so before we go to inventory, I think, yeah, there is a question that we can deal with. So this question tells us that Akate Farms operates a dairy farm. I think we all know Akate Farm. And on January 2011, he owns 100 cows worth 1,000. So they are 100. They are 100 and they are worth 1,000 each. Okay, they are worth 1,000 each. All right, on the market. At 31st December 2011, he now owns 105 cows and that are worth 1,100 each. But it goes on to tell us that during 2011, he sold 40,000 gallons of milk at an average price of 5 cedi a gallon. All right. When cows are sold at the local market, the auctioneer charges a commission of 4%. 4%. How are you going to go through and deal with this question? It says show extra from financial statement for 2011 for these activities. Assuming no cows were purchased or sold during the year. So that is what we are going to go through and figure out. But let's look at how we are going to value the biological asset to see if we have any something to take to the valuation surplus. All right. So what we are going to go through here is let's do some workings here. Okay. So let's try and value the assets during this period. If you are going to go through and value the asset, remember they told us that we had 100 at the beginning. All right, and we have 150, 105. Where are you? 105. What? Now, the thing you need to really be careful and look at is that if you are going to go through and value these things, they had 100, he owns them. All right, so we need to now determine the value of these ones coming the end of the year. So let's see the value of the 100. The value of the 100, and we are doing this valuation at 31st December because when it comes here, we already know the value. All right, we already know the value. Okay, so if you are going to value it, the question told us that at 31st December he owns 105, but the question is also telling us that when cows are sold to the local market, Oceania charges 4%. All right, we need to look at that. Then what we are supposed to also understand in this question is that we are supposed to do this assuming no cows were purchased or sold in the year. So what we need to really understand is that he owns 100 cows at the beginning of the year. At the end of the year, what we see here is that the number has grown to 105. So what we can see here is that if that is the case, then it means what happened for this growth to happen? Probably they gave birth. All right, they gave birth. Okay. So what you are going to go through and do is that they tell you that the Oceania, if he said that when cows are sold, the Oceania at the market takes 4% of commission charges. So if the price of the thing is 100%, then what you are going to understand is that the commissioners take 4%. All right. Now, what is this thing for? Remember, less cost to sell, estimated cost to sell. This is what we are talking about. So if the value of the thing is 100%, then it means that the commission of the auctioneers are 4%. So what we are going to go through and measure is that we have 100 cows, which at the end of the year, we would value at 100, and their price is 1,000 each. Okay. Now, what this is going to give us is that it's going to give us our 100%. What is the fair value less cost? So we remember it is fair value less estimated cost to sell. All right. What is the cost to sell? The cost to sell is the 4% that we are seeing here. All right. So be very, very careful. Be very, very careful of that. So what we are going to go through and do is to take our calculators and multiply the figures that we have. If I punch my calculator, you will see that I'm going to actually, this is the value itself. If we are going to less cost to sell, it will be 4% of this value. So let's represent the value by 100% and take off our 4%. All right, you can as well do it like this. You have 100,000, you are multiplying by 1,000, which will give you 100,000. All right, what is 4% of this 100,000? You do 0.04 times 100,000. It is going to give you 4,000. All right, so that is what is going to happen. 4,000 multiplied by the 4%. If you do this and you get 4,000, you need to still come and take it out of this figure, all right, which will land you out at somewhere 96,000. But if you go through and apply this concept that I've done here, your answer is going to be a straight 96,000. All right, it's the same, it's just mathematical precision. All right, so we now have the valuation of the 100 giving us 96,000. Let's see the valuation of the 105 is the same concept that we are going to go through here. The old 105 and this is the new price, but the commission says that when they are sold at the market, it's still 4%. So what we are going to go through and do is that at the same 31st December, what you realize is that you now have 105 multiplied by 1,100. You take off your 4%. So the presentation here, you can just go ahead and do -4 in terms of percentage. And what you are going to get here is 105. All right. So what I have here is 110,808. All right. Now remember, this is the final figure that we have for our 105. Okay. So you see that something that we had at this point has increased to valuation of 105. They have increased now to 110,880. You could see there is a difference here. So there is an increase in the value. All right, what is the difference? I think the difference is 14,880. All right, where will this one 14,880? Remember, it's again, and you need to go through and represent it in our P&L. All right, so this is how our P&L extract is going to look like, and our balance sheet will look like. So we will have our SOFP. Remember, our SOFP, our carrying amount has to come in to our NCA. All right. Now, there is an NCA, and you saw that as at 31st December, all right, we had their number to be 105. We multiplied by 110, 1,100. All right. Remember, you have to go through and do 100 minus 4%, which gave us a value of 110,880. So that is the carrying amount that we take to our balance, because that is the value of the assets at the end. All right. Now we need to show how it comes out in our statement of profit or loss. All right. So how does it? So we will have a revenue. Remember, they had some produce, all right, and those were selling for 5 Ghana cedis. So we will go through and record our revenue. And we now had a gain, all right, which was the increase in value. All right, and that one was 14,880. So it's just as simple as this. It's very simple. Very simple. The key important bit is the subsequent measurement, for which you need to know that initial measurement is valued at fair value less estimated cost to sell. All right, and that is what you do. Okay, that is what you do. Now, if you have that, you put that one down. You only use the cost model here when you don't have fair values to use. All right. If you know your initial measurement, then the subsequent measurement compulsorily you need to value at fair value less cost to sell. All right. And when you do that, it is still a fair value, and any increase in that, just as you saw in the year, the increase of 14,000 didn't come as a result of purchase or any sale. You see that probably they gave birth or something. All right, they did not add to it. The thing kept increasing, and that increase is treated in their profit or loss. All right, so take note of that. Very important. Let's now go ahead and deal with how we talk about the produce after harvest, which is IAS 2 inventory. IAS 2 inventory. Okay. Now, as usual, we are going to go through and talk about definition. We will look at recognition, and the third aspect, we will look at measurement. Okay, so what is the definition of IS2? What is an IS2? What is IS2? IS2 is about inventory. So what is inventory? Now, when we talk about inventory, what we are trying to look at is the assets. Inventory is an asset. It's held in the ordinary course of business. All right. And the inventory you hold on your ordinary course of business is your finished goods. Okay. And it's also used in the production of goods and services or process. So it's also used in the production process, all right, goods and service process. And that one, we are talking about the work in progress. All right, inventory is also consumed, assets held and consumed in production, all right, in production. And that one, we are referring to the raw materials. All right, so all these are categorized as inventory. So if you sell them, you hold them in the ordinary course of activity, it's inventory. If you use it in the production process, work in progress, um is also inventory. If you consume it in the production process, it is also inventory, i.e. raw material. Okay. All right. It is an answer, therefore, the recognition criteria is simple, right? It's simple. We recognize inventory, so we have probable economic benefit flowing to the entity. And we also have what we call reliable measurements of cost. All right. Take note of that. For measurement, we are going to go through and talk about the initial measurement. And we will talk about the substance. Okay. All right, initial measurement is always at cost. All right, and by this time, you already know cost. All right, so what we are going to go through and do is to talk about subsequent measurement. Our subsequent measurement, inventory should be carried at cost, and we have, let's say, net realizable value. So inventory subsequent measurement is carried at the lower of cost, net realizable value. All right. When we say cost, cost here we are talking about is any cost incurred in bringing the thing into its useful condition. That one, I think by now you know already. But what about net realizable value? Net realizable value is the selling price. All right, the selling price less cost to sell or complete. All right. Okay. So that is that. One thing you need to also appreciate is that for valuation of cost, the standard has restricted us to FIFO and weighted average. All right, weighted average cost. All right, you can change from one to the other, but remember it should be accepted by the standard. If but actually hardly are you allowed to change, all right? But only when it is accepted by the standard, right? And it is a fair representation of what things are. Okay, so you can't just go out, this year you use FIFO, next year you use WAC and all those things. Bear in mind, most importantly, LIFO is not accepted. It's not accepted. All right. Yeah, so these are what you need to know under IAS 2. We need to go through and probably practice a question on it and see. All right, so let's go through. There's an illustration there that you could take your time and go through, but we want to consider question one here, Jota. Unfortunately, a good player as he is has suffered injury and likely to miss the World Cup. It's very painful, very, very painful. So Diogo Jota has paid 3 cedis per unit for raw material of each product. To complete each unit, he incur 2 cedis per unit in direct labor. And the production overheads for the year is based on normal output. And the unit was for 12,000 units is 72,000 as we have here. Then during due to industrial action, only 100,000 of the products were produced, and 1,000 are still in inventory. So our concern will be majorly on this, which is closing stock. All right. As a result of the industrial action, some units were badly stored and became damaged. It is estimated that 200 of the units will now be sold at 12 cedis after minor repair of 260. So our main concern will be this 200. Now, what is the cost of the material? We need to know the cost per unit. Per unit here. Remember, we said we have materials, all right, which cost 3. Then we have labor. The labor is said cost 2. In cost production, these overheads too are there absorbed in here. You could see that we have 72 Ghana cedis. But what we are looking at is the per unit. So we need to go ahead and put 72,000 all over 12 to get the per unit. And that one should give us 6. So the total cost here is 11. So that is the cost of the asset. That's the cost of it. Now this actually tells us the selling price of the asset and minor. So if we now want the net realizable value, we now need to take the selling price and take off the minor repairs that we may be doing and end up at. So we have the cost, we have the net realizable. Now what we are going to go through and know is that the closing stock that we have here, the story continues to tell us that we have 200 which will be selling at this, and we break it down, we have 800. So as for the 800, we are good to go. It's actually 11 cedis, nothing is wrong. But this one, you realize that they gave us a story around it, and that one is going to go for this. That particular one has a net realizable of 10 against 11. Which one are we going to use? Remember the law of cost. We are now going to apply. What then is going to happen is that if you multiply the 10, we are having 2,000 cedis here. And if you multiply 11 here, we will go through and have 8,800. So the closing stock of 1,000 units is now going to give us something around 10,800. All right, instead of the 11,000. 11 cedis multiplied by this, all right, to give us 11,000. What is going to happen is that we are going to, this is what. So this is the value that we will use for our closing stock and for the closing stock that we should be using in our P&L. All right, so that is that. It's not difficult at all. Not difficult at all. All right. So always remember to take the lower of cost, okay? The lower of cost and net realizable value. That is the most important bit. All right, this part. Okay, so that is all from inventory. We now need to go on and look at another standard. Which standard can we look at? Let's try and deal with IAS 8. Let's go on and deal with IAS 8. Now we are talking about IAS 8, what we are going to do. So this will be our third standard for today. what we are going to do, the concept under IAS 8 is accounting policies, changing accounting estimates, all right? So let's go on with our notes. Okay. Now this standard is actually given to us so that we will be able to select accounting policies, all right? What governs our selection of our accounting policy? What governs our changing in accounting policy, changing accounting estimate, and errors, all right? So the standard is actually called changing accounting policy, changing accounting estimate, and errors. So what we are going to do here is to split our board here into three. And at this end, we are going to talk about change in accounting policy. And over here, we are going to talk about change in accounting estimate. And here we will talk about errors. All right. Now, what we need to go through and understand is these things. What is change in accounting policy? Accounting policy in the first place is the specific principles, all right, the basis, called the conventions, okay, the rules, the practices, right, that are applied by an entity when they prepare their financial statement. All right, so these are what the practices, what you go through, those things that you consider, you go through to prepare your financial statements. All right, so that is accounting policy for it. The standard tells us that an entity is supposed to select and apply appropriate accounting policy, all right, of the IFRS standards. You need to do that. You need to do that. Okay, it's very, very important. Very, very important. Now, when you are doing this thing, you need to make sure that the information that you are using is relevant. Okay, remember, it's relevant. Not the information that you use to determine your policy. Let me mention that because it can come for you to state them for some marks. All right. What if you are going to go through and use any of these policies? Remember that the policy should depict faithful representation. It's very, very important. Faithful representation. And what do we mean by faithful representation? What we are going to go through to explain to you is that if you remember, we talked about completeness, first lecture. All right, we talked about neutrality, and we talked about error-free. All right, so these are the things that you need to take note when you are selecting an accounting policy. It's very, very, very important. All right, it's very important. The next thing you are supposed to understand is that the information has to be relevant. All right, to decision making. All right. Do you remember predictive value and informative value? All right. Those things you need to go through and understand. Okay. All right. Prudency has to be exhibited. So that is that you need to know. Okay. Now, what we are supposed to go through and discuss is why an entity would change a policy. And what are some of examples of policy we are talking about? And let me give you an example of a policy. Now, let's say you have depreciation. Okay, depreciation. Sometimes you can treat depreciation as a cost of sale item or as an administrative expense. Why you are representing it as part of your cost of sale or as part of your administrative expense is what we call change in accounting policy. So if you were using it in cost of sales, you now want to bring it into administrative expense, you need to consider all these things, faithful representation and its relevance. All right. All right. So that is a typical example of a change. So in terms of talking about the change in the accounting policy, yeah, so that is what I was explaining to you. Okay. All right. So if you are going to change from one to the other, what you need to do is that the change, number one, is required by standard. Please, these things are for your 2 marks answering questions. Right? So it is required by an IAS or IFRS standard. All right. Okay. Then another reason why you will go ahead and change accounting policy is that you can only change if the change is going to bring about reliable and more relevant information. Okay. All right. And more relevant info. As a matter of fact, it means that the thing is going to be faithfully represented. All right. So that is it. It will give more relevant and reliable information to users. All right. That is the only reason why you change. That is the only reason why you change. Now, you remember when we were dealing with borrowing costs, the interest sometimes was split. Some goes to expense, some go to the PPE. Why it is like that is a policy according to IAS 23. So you need to understand. Okay, so the recognition of an expense rather than an asset is a policy that you have. The presentation, correct? So when we are talking about change in accounting policy, we talk about these three things: recognition, we talk about presentation, okay, then we talk about measurement. So we say that a change actually occurs when there is a change in the recognition. All right. So change in accounting policy is when there is a change in recognition. Example, like I said, from expense to part of an asset cost. All right. Presentation, I gave you an example. If there is a change in the presentation, then it is a change in accounting policy. For example, we are talking about presenting depreciation in cost of sales or admin expense. That one to amount to change in depreciation. Okay. There is also change in depreciation when an asset at their replacement cost rather than their historical cost. All right. So replacement cost other than their historical costs. All these things amount to change in accounting policy. All right, so that is that. We will later go on and show how the accounting treatment is. But let's understand what a change in accounting estimate is. What is a change in accounting estimate? Remember, estimate in itself. Estimate in itself are judgments. Yeah, subjective judgments. All right. Yeah, subjective judgment. All right. It's an estimate. Okay. So they are just something that we also understand estimate to be adjustments of the carrying amount of an asset or liability. Those of you who have undergone audits in your office, you always hear, let's pass the adjustment, let's pass that, let's pass. All right, so that is an adjustment for you. That is it. Okay, we now need to go ahead and talk about errors. Errors, we are talking about omissions and misstatements. And misstatements. All right, those are what errors are. All right, but particular attention is given to prior period errors. So there are errors that you might not see last year that okay, you only come into this year to see when the account has already been published. What do you do? How do you do to correct the errors? All right, so we'll come back to the accounting treatments, all right, of all these three categorization of IAS. And what you are supposed to know here is that we talked about the presentation of depreciation. Remember how you determine the depreciation itself, all right? How you go ahead and determine the depreciation is the methodology. Probably you have straight line and reducing balance, all right? So if you are going to change from one of these estimation methods, all right, then it amounts to a change in estimate, all right? So be careful about that. Okay, so that is that. But the key important thing is that when these things are changed, what happens is that when it comes to change in accounting policy, any change in recognition is a change, presentation is a change, and measurement is a change. All right. So you need to know that. You need to know that. Okay. So if let's say if an entity, for example, previously charged interest cost in relation to any loans, all right, for the construction of assets through their profit or loss, and later following borrowing cost concept, uh, it now capitalizes the interest. That one is what we call there is a change in the recognition, all right? So it was an expense, now it's going to an asset. That one is called what? Change in accounting policy, all right? So that is that. So you ask yourself, is it a change in recognition? What is recognition? The element of financial statement. Has it moved from one of them to the other? You need to take note of that. What about presentation? You check your IAS one, how financial statements are supposed to be presented. Is it moving from one of the lines to another? That one too, you need to know that is also a change in accounting policy. All right, so you take note of that. So, for example, if an entity previously showed some overhead costs within its cost of sales, and it's now decided to show those overhead costs in its administrative costs, that one will amount to change in accounting policy. All right, so you need to understand that. All right, so it's very, very important. There is a change in the presentation. If an entity, let's say, previously measure inventory at work, all right. If they were using WAP and they are now changing to, let's say, FIFO, then you should see that there is a change in the measurement basis, all right? The measurement basis. So that one to amount a change in accounting policy. Please understand that, all right? The change in the change in estimate we are talking about concerns those subjective judgments, right? Those subjective judgments. All right. So, for example, we are talking about the change in the useful life, a subjective judgment. All right. How do you know there is no standard concerning the useful life of an asset? Okay. The change in scrap value, all these are estimates. The change in scrap value is an estimate. The method itself of depreciation, I mentioned that. Okay. There is no space for me to bring these ones that I mentioned, but I mean, once it's a change in recognition, presentation, and measurement, you should know that. All right. If you do a change in provision, all these things that we are talking about here, they are subjective in judgment. So those things amount to change in accounting estimates. All right. So you should know that. Okay. Now, here we are just talking about mathematical mistakes or classification mistakes. So that is what we are talking about. So we are saying measurement mistakes and classification errors. All right. Okay. We now need to go through and know the accounting treatment embodying these things that we have talked about. So let's go on and split our board into three as we did. And the first place is for changing accounting policy. Second bit is for estimate. So we are talking about accounting policy. So what we are going to go through and understand is the accounting treatment. What you should know is that you have to, the standard says that changing accounting policy is applied retrospectively. All right. So what we mean here is that the new policy is applied, and you, because you need to go back retrospective, you now need to go back and make some adjustments on your retained earnings. All right. So you have to restate your retained earnings. All right. Because that change that happened, let's say in terms of the inventory, will bring something differential in your closing stock. All right. Determination. And that one will mean that you have to go back and affect your retained earnings of last year. All right. In this year's account. We will do some computations and you will see what I'm talking about. Another thing you are supposed to do is to actually disclose the effect of the change in your statement of changes in equity. All right. Then you have to restate your comparative. Okay, because you've changed something concerning last year, you need to state the comparative. All right. So that is that. That is how you go about with the accounting treatment. It is applied retrospectively. You have to go back and do affect the comparative information if it is practicable to do so. But if it is impracticable to do so, there's nothing you can do about it. So you need to now go and make an adjustment in your retained earnings. All right. So you adjust your retained earnings. All right. Okay. But if you cannot go ahead and do these adjustments that we are talking about in the opening retained earnings, you cannot do that. Then the change should be adjusted in the prospective uh, uh, in the prospective terms. Okay, you need to go on and be applying the change prospectively. Okay, and include in the current period of your statement of profit and loss. All right, so that is that. But I think you have the opportunity. All right, so that is that. Coming to change in accounting estimate, the standard says that that one has a prospective treatment. All right, so once you've changed, you need to continue to apply change as you do. So it's prospective, all right, to look forward. The effect of the change should be now included in your profit and loss. Okay, so if the change that you did brought about some effect, the effect of the change in the accounting policy should be included in the statement of profit and loss in the period of the change. Okay, in the period of the change. All right. Then if subsequent period are, so what we mean is that apply the effect in the P&L in the period of change and subsequent period. So it's present to prospective, okay? All right, so that is what you need to do. That is what. Another thing you are supposed to do is that if the effects are material, then you need to disclose it. All right, so okay. Okay. So that is what you need to know. That is what. Okay, so that is it. When it comes to the errors, we need to go back and do the same thing here. We do a retrospective treatment. And how do you go about doing that? If the error is relating to past years, then we need to now do a restatement of the opening balances of the element it affected. Okay, so we say that number one, you have to restate the opening balance of if it was an asset of the asset, right? If it's liability, you do it. If equity, you do it. You do that as if the error never occurred. So that the opening balance of that particular asset in the current year we are in is okay, as if the error never occurred. If what you are going to go through and do is the corresponding entry affecting the profit and loss of last year will make us to adjust retained earnings. Okay. Retained earnings. So that is what is going to happen. Not only that, just as the other side, we need to disclose effects in a statement of changes in equity, and also restate our comparatives. Okay, so this is what IAS 8 is all about. What we now need to go through and do is to take some figures and deal with the mathematics Okay, so let's put up some uh, questions that can help us deal with this. There is an illustration there in the manual. You can go ahead and take a look. The solution is there. So with explanations, and so you can have time to go through there. So you see that I've said there for each of the item, when it comes to changing accounting policy, you have to ask this question. If the answer is yes, then it's a change in so these are errors, as you can see here. If you want a copy of this manual, you can contact me. I'll give you a hard copy. All right. Let's move straight to the question. Errors to have been shown here. All right. There are so many illustrations in there for you. Let's come here and talk about this question. How many questions do we have? I think we have one. All right, so let's deal with this question. All right, so whether changing accounting policy, whether errors, the treatment is the same. Okay, so that is what happened. So let's look at this. We have, while Mensa Trading was carrying out audit in 2013, it was noticed that the depreciation on PPE was incorrectly recorded in the book at 30,000 instead of 50,000. So that is what happened. Okay, so this one is a pure changing, it's an error that has happened. Okay, so it could have been a change in policy. So what we are interested in is the same methodology. All right, it's the same thing. Changing, errors has the same treatment. Okay, so that is that. Now, we now need to go through and look at the figures for 2013 and 2012. So this is what we have. Okay, so if we go down the question to continue to read, they gave us the retained earnings of Mansa, and that is what we have here, right? And they tell us that Mansa pays an income tax of 20% in both years. All right, so what we are going to go through and do is to try and see the accounting treatment that we give it. Remember, these ones are with respect to adjustment. So what we learned is that when we have situations like this, we need to go through and restate the opening balances of this one is a P&L item. So what we are going to go through is to try and restate the thing as if the error never happened. All right. As if the error never happened here. And let's see what we're going to get. Okay, so let's try and do the correct thing here. Okay, so we're going to go through and have our 350. Nothing is wrong with that. We're going to go through and record our 90,000. Nothing is wrong with that. We're going to go through and take off our 20,000. Remember, this is where the problem is. They said it was 50,000. So if you are going to go through and record the correct amount, what we're going to end up here is actually 190,000. 190,000. Okay. So that is that. That is that. Which will end up having what will be our tax thereon. If you are going to apply our tax of 20% is actually 38,000. So it means that the error has even affected our tax. There is an overstatement here. All right, if we're now going to go through and find out what our real total should be, our net profit should be 150,000. Okay, so what we are going to go through and do is to actually correct the retained earnings that we have in here. So after we've done our restatement, what we're going to do is to also try and restate our opening balances of the retained earnings. So retained earnings adjustments, like we ought to do. So we have 2013 and we have 2012. All right. So the opening balance of retained earnings for 2012, yeah, will be 50,000. And this closing of 2012 becomes the opening, as we see here. So we need to go through. These are opening balances at the beginning. So we have 280. What we are going to go through and do is to correct the error and bring in our prior year adjustments. These are normally done in the statement of changes in owner's equity. So you see that the difference between this figure and this figure that we have is actually 16,000. So that is what the change brought. All right, so we now need to go through and reduce this to 18,000 to what it should be. All right, remember there is this 50,000 in there already, and this is what we are changing. Okay, so you realize that the correct retained earnings should actually be this figure, 50,000 plus this one that we have, which when you go through and add, we are going to get the same thing here, which is 202,000. All right, so that is how it should be. All right, we now need to go through and present our net profit for these years. So the net profit for 2013 is actually what we have here, 176,000. And the net profit for 2012 is what we actually have, not this one. No. So we need to bring in our 152. At the end of the day, you realize that we have 202,000, which is the correct adjusted retained earnings here. And we now have 378,000. So that is how we go through. And what you see here is that there is an effect on the income tax. All right, there is an effect of the income tax. Now, the company will have to disclose the error. All right, so you have to disclose. So remember, disclose the error. All right. So what you're going to do is that you are going to disclose your error. So you realize that here, the depreciation error on the PPE, you see, it is going to affect the PP. Okay, so you are going to disclose understatement, depreciation, on PP. So whatever the value of the asset is, remember, we need to go on and restate the opening balance correctly of the PP, okay, the carrying amount in the PP, the balance sheet or statement of financial position. We need to disclose them, all right? And we have gone ahead to adjust our retained earnings, all right? So which we have done here. All right. The last thing we need to do is to also reinstate our comparative amount, okay, to correct the error as if it did not happen, okay? So you reinstate your comparative. What you see here is that the income tax before correction, you see the income tax before the correction was actually 42,000. Now, the correct amount that we did is actually 4,000. And the new tax figure as restated is giving us 38,000. All right, so that is what you need to know, and that is what go through. And all right, so that is all about IAS 8. Okay, we now need to go on and look at another standard quickly. We said we will be doing 5 standards this morning. I think we've done 41, IAS 2. What again? We've dealt with IAS 8. Yeah. All right. Okay. So let's go on and tackle another standard. Probably talk about fair value measurement. I'm going to make it very fast. It's not a standard that IFRS. All that I need to tell you under IFRS 13 is that IFRS 13 is concerning fair value measurement. So we say that in the standards that we've been discussing prior to this, we should measure things at fair value, less cost to sell, fair value this, fair value that. Now, what is the fair value? What is the fair value? You need to understand what the fair value is. And so I'm going to go through as usual and talk about what fair value is. So, like we always do, I'm going to talk about definition. All right, this is a pure theoretical standard. Now, when we talk about fair value, what we really interested in is that it is an arm's length measurement. Okay, so what we are going to go through and start is what you already know under arm's length measurement. So, what is a fair value? Fair value is the price at which one will exchange a liability or an asset for a consideration, right, between two market participants. and that is what we've known in all our accounting study. All right. So we say that fair value is the price that would be received for you to sell an asset. All right. Or a price that you pay to transfer a liability. All right. In an orderly transaction between market participants at between two market participants at a measurement date. At a measurement date. So what you are going to go through to understand is that when we are talking about fair value, we are actually talking about the exit price, the price at which when you left the market, you gave out. All right. So that is that. I always personally call it the final bargain price. All right. So you go to Ashama market, they sell tomatoes. You go to Tema market, they sell tomatoes. You go to the market I love most, the one at Edun Kumasi, all right. PJTR Central Market, Bode Market, wherever you go, all right. In Kumasi, that is where I grew up anyway. So you go there, you tell, especially when you want to buy things in the Edun Kumasi, don't just go there asking for prices. Let me give you this simple technique. You have to know about the market of what you are going to buy. I mean, the prices of it. When you go, just simply issue out the money, the person will give you the item. But if you go and you ask for the prices, this is when they will shoot the price so high. You have to now start from below and be bargaining. So where you actually land at to take, let's say, a shoe or something, that is your exit price and it is your fair value. So quickly, what you are supposed to go through and know is that IFRS establishes a hierarchical categorization of the input to the valuation of the fair value. The input we have level 1 input. We have level 2 input, and we have level 3. What you are supposed to know in the level 1 input is the quoted prices. Quoted prices in an active market. For identical items. All right. So suppose you go to Ashama market, you see the woman, or Tema market, you see the woman selling tomatoes. They are rich. You see tomato here, tomato here, tomato here, tomato here. The Burkina tomatoes nicely arranged. Okay. And when you go there, you ask for the price of this, ask for the price from this woman, that woman, and that woman. You see that you are having. So a quoted market is a market that is homogeneity, all right? They sell one thing, homogeneity of goods, and also the prices are publicly displayed. All right, so it's not hidden, all right? All right, so you can get your fair value from this type of market. All right, so that is that. Level two, the standard makes us to understand is the quoted prices of similar items or similar or identical items in an inactive market. So if you have an inactive market, then you are going to go through and also find out these items. All right. So here we call them observable inputs. Call them observable. All right. You are going to go there and try and also get the price. So let's say if you want the price of is it this way? Yeah, if you want the price of this way, you are not getting in any market. And you can actually get the price of is it Nescafe 3-in-1 if they perform the same kind of thing and their FAR analysis functions perform assets use, right, and all those things you learn under transfer pricing. If they are close, all right, okay, they may be similar, but we say identical, but they may not be identical, all right. They may be identical or not identical. It's not like it's one of them, identical, identical. All right, so that is that. If you now have it, then you are going to go through and use those ones. But you will have to do some little degree of adjustment, all right? Because the pack that the 3-in-1 is in is maybe different from the this way, all right? I think Cowbell has also some 3-in-1 and the this way people have some 3-in-1, but you need to go through and probably consider some FAR analysis. Those of you who have done transfer pricing understand. We are talking about the functions that perform in producing it, the assets you use. All right, so that is that. Now, the level 3 input, what you are going to go through and do is that you see that there is no observable input. So we are talking about this case, non-observable, unobservable. Input, all right? You are using unobservable input based on the best information. All right, and this is the level where even the custom people prices commodities often, all right? Because they believe that people might reduce the cost of the thing just to reduce the tax payment, all right? So they'll use best available, information that they get to determine the price of the unobservable input. All right, so that is what we go through and use. All right, so this is what fair value is about. There is no mathematical computations around it. All right, this is how fair value is about. And what you need to understand is that in terms of the fair value, we are talking about recurring fair value. All right. If you remember when we were doing IAS, we have the recurring basis, right? You saw that the thing, if you remember what we did in IAS 40, you saw that the value of the thing at some point was 21 million, and at the end of the year, it went to 21.6 million. All right, so these are recurring fair value, sorry. And the standard requires that the fair value that on an ongoing basis. Right? So you need to, we dealt with this, yeah. And for the non recurring basis, We will be looking at some about determining our goodwill in business combinations later. All right. So what you need to go through is the measurement of what we did. We say that when you are measuring the fair value, an entity for an entity, then you have to take into account the characteristics of the asset. Right? So take consideration to the conditions, all right? So the factors we are talking about is take the condition of the asset. All right, the condition also take consideration to the location. All right, and check if there are any restrictions. All right, these are theoretical things, and that is it. You are supposed to also disclose the fair value levels that you use, okay, how you did your valuation, okay, you are supposed to go through and disclose your fair value. All right, so basically that is it. And fair value. Let's look at the last standard for today. We are going to go through and do IAS 10 events. Events after financial. Okay, if you are going to go through and talk about events, what we need to understand is that there are events. So we are talking about, let's talk about definition. And here we are talking about events, favorable or unfavorable, that occur between the end of the reporting date and the date financial statements are authorized for issue. All right, what I'm going to do here is to draw a graph for you to explain this out. Here are 2 days. We have 2 days here. We have the date financial statements are authorized and the report. So we have a timeline here. So we have the reporting date. And we have authorized date. All right. So in between this timing, if let's assume accounting year is January to December. All right. So that one means that here our reporting date will be 34, whatever here. All right. Then here, if you are in Ghana and your accounting year ends in December, you have not later than 30th April. So if this place is supposed to be, say, 2021, then you have not later than 2022 April. Of course, you can seek for extension. Multiple extensions. Extension will not exceed 60 days. So it means you have a maximum of your extension should be submitted to the regulatory authorities, e.g., if it's GRA and registrar of companies. All right. So what we are talking about is this the things that happen in between these things. So we are talking about events. So that is this timing is what we are talking about. All right. So that is that. And remember, sometimes, example, you may have closing inventory as at 31st December, but you realize that those inventories are now going to be selling at their lower cost, all right, around, let's say, 6th of January. If you realize that what are you going to do? Because at this point, the account has been prepared. If I'm to go through and even use March, this point, it has not been signed off, all right? So that is it. Do you go back and adjust, or you don't go back and adjust? So the standard goes ahead to distinguish these events and call for what we call adjusting events and non-adjusting. All right. What are adjusting events and what are non-adjusting events? Oh, so what you are going to go through to understand is that adjusting events are events that give indications of conditions that existed, all right, at the end of the reporting date. Okay, they give indications of things that existed. All right, so okay, so that is what you need to understand. They give indications of things that existed at the end of the reporting day. It means that the thing was already existing, all right? It was already existing. So it is not like it is now about to happen. It was already existing. Okay, so what you are going to know is that for what you are seeing, they are just stories that is being told you about something that already existed. It's not that it is now happening, all right? So it affects already existing elements before let me say to the reporting date. All right. So it is not like it is happening afresh, but it's actually telling you an additional story of something that is already existing. All right. So that is that. Let me give you a typical example. If we are in 2021, as you see, and we are served a court case, all right, that one will mean that we are aware of probably a potential liability that is coming to us. Okay, so what is going to happen? You now need to consider that inside your financial statement, all right? You now need to consider that inside your financial statement because it is actually when the court case is now ruled somewhere in the following year, what is happening is that you already knew of it before the end of your reporting date, okay? So that is what we mean. You have to come back and do something to it. All right, so that is that. So we are talking about the events between the reporting date that provide, we call it, you can also call additional evidence. So the event provides additional evidence. So it's not a new evidence, it's an additional evidence, all right, of something that existed. All right, something that existed at the reporting date. Okay. All right. So example of these things are, um, let's say bad debts, because the receivable is also already in your books, right? And it is arising after the reporting date, which may help you to quantify your allowances to the receivable at the reporting date. Okay. All right. Then another example is what I just said about inventory. All right, where you have the lower of cost and net realizable value. Okay, all right, and uh, discovery of fraud. Now, if these things happen at this point, then it means that it's an adjustable event, adjusting event. What do you do? The accounting treatment says you should go ahead and adjust. All right, go back and adjust. Okay, because at this point, it hasn't been signed yet. You can, if you are an auditor, you understand what I mean. You can pass your adjustment. All right. All right. But if it exceeds this date, then you are nearing event IAS 8. All right. Changing policy. All right. That is where you are getting to. And errors. All right. Okay. So that is more. All right. Let's look at non-adjusting. Non-adjusting event hearing. These are events after the reporting date. But these ones are it concerns conditions. It concerns conditions that arose, that just arose. So it just happened, all right? It just happened. It just happened, all right? It is starting afresh, all right? And it has no link to the elements of financial. It didn't happen during the period, okay? So it is now happening, all right? Okay, so that is that. What you are going to do, example of things like a business combination idea. So you decide to go and merge with somebody or acquire somebody after the reporting date. It's a fresh news, all right? Okay, you are going to close down one of your major as a production line, or there is a distraction, close down. All right. And what we have experienced, people were asking, so things that happened, especially in 2020 when the COVID came, people were asking what is going to happen to financial. I think there was some standard that came around that time to do with it. All right, so we are talking about abnormal rise of prices. All right, what the standard wants us to do here is that whilst we are adjusting for adjusting events here, we are supposed to disclose them. All right, so that is that. That is that. That is that. All right, so that is all about IAS 10. Let me quiz you small with some events and see if you can be able to tell if these are adjusting. All right, so these are some of the examples that you see here. All right. Take your time and look at them because I'm going to ask questions. All right, let's quickly go through the question. This is the question. The following event took place between 31st December 2017, reporting date and the date financial statements were authorized for it. And these are the issues. All right. Now I said that the company issues 100,000 ordinary share and raises 200,000 shortly after the statement of the financial reporting date. Adjusting or not adjusting? Of course, it is non-adjusting. All right. Why? Because it does not give evidence of a condition that existed at the end of the company will now go ahead and would use the new issue share for the calculation of maybe their earnings per share. All right. There is a legal action that has been brought against the company for breach of contract prior to the year end. In fact, this one alone, we don't need to continue. We just have to say it is adjusted. All right, so what is going to happen here is that they tell us that this is the amount of the damage that we need to now make provision. All right, so that is inventory included in an account for 25,000. All right. Oh, so this one too is simple. It is an adjusting event. All right, so what you are going to go through and do is to record impairment of 10,000 to reduce this one to 15,000. Right. So that is that. They go ahead to tell us that a building in use at the SOFP date valued at 500,000 was completely destroyed by fire. Unfortunately, half of the value was caught. Unfortunately, only half of the value was recovered by insurance. Adjusting or non-adjusting? Remember distractions. So you have to what? Disclose. Tell us about it at this date, all right, but in that particular year it happened, you will have to be passing your impairment. But as at this date you are concerned, you have to disclose it so that whoever wants to make an investment decision will know that even the company is suffering as at this point. All right. So that is that. Now, what I need to add to you is that in these times of these situations, uh, damages, the going concern, yeah, is affected. All right. So that is that. That is that. And when it is that, the entity then has to prepare the statement of financial position on breakup basis. All right. Breakup basis. That is all you need to know. All right. So thank you very much. We've been able to go through 5 standards today in this class. We'll make sure we will move on to IFRS 15 and the other standards, all right, to catch up by the close of this week. All right. So take your time, watch the videos, and solve more questions. Thank you very much.